It's no secret the stock market is filled with highs and lows. And like the weather, the forecast can change anytime. And here with ways to keep market corrections in perspective, today's Your Dime sponsor is Rooted Wealth Advisors Duke Smith, Chief Retirement Strategist. So today we're talking about market corrections. But first we got to know what exactly a market correction is.
Yeah, so one word we've heard a lot about this year is volatile. And the stock market has been volatile. And part of that volatility is market corrections. Now, market correction is going to be a drop in the market of over 10%. A lot of people confuse this with a bear market, but in comparison, a bear market's a drop over 20%, or corrections between 10 and 20%, a pullback being somewhere between a 5 and an 8% drop.
And so I'm guessing this has some kind of effect on our investments.
Yeah, so anytime we see a correction, if you look at your 401k or an IRA or any investment account, there's a good chance you're going to see some sort of drop in it. You're going to see some loss in value in that account.
Does that mean time to panic?
Not necessarily. Now, if you're taking distributions off of that account, it means a little bit more than if we're still working, saving into those accounts. Or if we're still saving, that's more of a buying opportunity for us rather than a time to panic. We really have to be focused more on this long-term plan rather than what it's doing on a day-to-day basis.
So it is possible to recover.
It is. Typically, a market correction is going to last about 4 months, and then it is going to recover from there. Like I said, we do have to stick to the long-term plan. Maybe a time to reevaluate that, maybe even get a second opinion on what your plan looks like.
Okay, so thinking about a plan, we need to be prepared, and so we need to know what to do when a market correction occurs. We've got 5 things to do when a market correction is occurring. Number 1 being be patient, which can be hard.
Yep, we do have to wait for that to come back. Like I said, with that long-term plan, we don't want to go scrapping the whole thing just because we see a correction. We don't want to overthink things as well. Typically, the instinct is to buy in when the market's rising and sell off when it's starting to drop. But statistically, we should do the opposite of what instincts would tell us.
So fight those instincts. Number 2, stay diversified.
Yeah, we never want to have all of our eggs in one basket. We do need to rebalance the portfolio, and a market correction is a great time to do that. When we think about what the market's done over the past few years, tech stocks in particular have soared more than any other. So it's sent a lot of people's portfolios out of whack and made people want to weight their portfolios more heavily because of the performance. But we do have to stay diversified and not have all of our eggs in one basket.
And then that's when the coming back to being patient
yep.
comes into play there. So if people need some help figuring this all out, our last step there is to work with your financial advisor, someone like you or maybe someone on your team.
Yeah, so we've got a guide that they can go download. It's complimentary. They can go to get that by going to marketcorrectionguide.com. There's a phone number there that they can get in touch with us as well. Follow us on social media. We're always putting out more information to help them out when it comes to planning for retirement.
So have no fear is basically what you're saying. Everything's going to be okay. It'll come back around.
Yep. Got to stick to the plan and make sure we're always updating that and having that ready to go for us and have our retirement planned out.
Yes, keyword plan right there. All right, if you need help making your plan or you have questions about understanding market corrections, oh my word, that's a great screen grab there your team has put on. I appreciate that. We'll connect you at CILiving.tv.